Good afternoon, everyone, and a very warm welcome to the first of our two-part series on global investing. I hope you're all well and keeping safe. Can't believe it's going on and on. It feels like months ago that I did my last webinar. I am Tracy Kutzer, and I'm lucky enough to head up the institutional distribution team at Stanlow. Joining me today from our global equity and balance partner, Columbia Threadneedle Investments, are our presenters, Alex Lyle, the head of CTI's managed funds. Hi, Alex. Felicity Long, multi-asset portfolio manager at CTI, and William Davies, global head of equities and CIO of EMEA. I hope I got that right, William. Welcome. As I think I may have mentioned in one of our previous webinars, we really have tried hard to provide you, our clients, with value-adding information over these uncertain times in an effort to help you sift through the noise and to make good investment decisions. We thought that the next topical area to cover on this month's webinars would be global investing, and we're extremely fortunate to have Columbia Threadneedle to help us do this. CTI has been Stanlow's global equity and balance partner since 2012, and the relationship really has grown from strength to strength over the years, and one which we really do leverage extensively through their thought leadership, research, global best practice, views on ESG, etc. And I know Herman van Velze, the head of the Stanlow Equity and Balanced Investment Team, is particularly proud of what you've built together. Today, we are excited to share CTI's Global Balance Team's expertise, views, and insights on global asset allocation themes, and importantly, how they are responding to rapidly evolving markets, and especially what this means for your portfolio. Something they certainly seem to have done well over this period, looking at your performance. So well done, Alex and Felicity. In terms of the agenda, Alex and Felicity will speak for approximately 20-25 minutes. Feels like a bit of a whirlwind tour, but we're hoping to have some time at the end to open up for questions. So please post any questions you have on the chat, and I'll definitely do our best to get to them. Alex and Felicity will then leave, and we'll hand over to William for part 2 of the series. So enough from me, over to you, Felicity and Alex. Thank you.
Thank you very much, Tracy. And good afternoon, everyone. I hope you can now see my screen. It's terrific to have another chance to speak to you all today to share how we see the world and financial markets evolving, how we're investing, and of course, answer any questions that you may have. But before we do that, I wanted to just spend a moment or two looking back at the past 5 months or so, because they have really been exceptional, both in terms of the global economy and financial markets. And before I hand over to Alex to share his views across asset classes and how he's reflecting those views in the Stanlow Global Balanced Funds. So coming first then to the economic impact of the COVID-19 pandemic, which has been pretty catastrophic. Here on the left of the slide that hopefully you can see in front of you, we show just a few examples of that synchronized collapse in economic activity, from US non-farm payrolls that are widely looked at and which proxy the health of the labor market and to an extent the US economy, to GDP here in the UK, and at the bottom, industrial production in the Eurozone, an area whose industrial recovery was already somewhat challenged before falling off its cliff in March. So really no doubt that this has been a huge shock, and one whose recovery is both uncertain and to an extent conditioned on healthcare innovation, vaccine developments. But a huge part of this story thus far has been about the support of policymakers. And as you'll hear in just a moment, this has also been central to how we've been investing this year. And just to give you an idea, on the right-hand side of this slide, the red bars are IMF projections for 2020 GDP for a number of developed economies. But the grey bars show the extent of the fiscal measures announced as a percentage of that country's GDP. So an enormous amount has been done already to fill the hole in activity brought about by those lockdowns. Now, central banks have too intervened to stabilize financial markets from late March, and they did so with great success. Here, we show the impact on equity and bond market total returns, both to that collapse in activity and then to the policy response designed to offset it. So having seen some markets fall more than 30% from their mid-February highs, many are now back to a whisker away from their all-time highs. So it's been something of a round trip this year for many asset markets. Now, our expectations for how the world recovers from here leaves us comfortable owning select risk even as markets have recovered. You'll hear more about that in a moment from Alex. And that expectation is for a gradual return to pre-crisis levels of growth, but with low inflation and continued low interest rates coming through. But expecting companies to come out of this crisis in worse shape than before. Across asset classes, we have a real focus on quality. And that is something that you're going to hear more about this afternoon, I think both from Alex and indeed from William. And so with that, I'm going to pass over first to Alex to share how all of this impacts our cross-asset class views and of course our portfolio positioning. Thank you, Alex. Over to you.
Hello, thank you, Felicity, and good afternoon to you all. Delighted to have a chance to talk to you about the balanced funds. First of all, I'll start with our views on the major asset classes, and I'll start with equities. And we've been above benchmark, the strategic asset allocation benchmark for the two funds throughout this crisis. And I've put on this slide that the major reasons why we've been supportive of equities since the start. First of all, the unprecedented action in terms of speed and size by the authorities to ameliorate the situation as much as they can. Central banks took interest rates down to zero effectively all around the globe, and we've seen massive quantitative easing. And that chart on the right-hand side shows the degree of central bank purchases from the four major central banks in the world. And you can see it is huge in size. It dwarfs what they were doing in the global financial crisis. We're talking about $6 trillion worth of quantitative easing in a 12-month period. And that's about 3 times the size that they ever got to in a 12-month period in the global financial crisis. And governments on the fiscal side have announced a series of huge packages to help. And as soon as the packages run out, they're pretty quick to implement another one, which is what they're trying to do in the US at the moment. So massive and swift action by the authorities. They've really said they will do what it takes. So that's very supportive of equities. Secondly, value increased obviously in the bear market. And if we look at the chart at the bottom on the left-hand side there, you can see that is the Shiller PE, which is the price-earnings ratio, the global price-earnings ratio, based on 10-year average earnings. And obviously, it was just getting a bit above average levels ahead of COVID-19, and then as markets collapsed when the pandemic came along, it took us well below that average line, throwing up some real value. So markets were cheaper. And thirdly, something we think is important is that the coronavirus is certainly a massive shock to economies, but we think it should be temporary. It isn't a structural problem, it isn't a deep-seated problem, which something like inflation can be or a financial crisis can be, that takes a long time to heal. We think once we've got through this, economies which were in good shape going into it should be able to bounce back reasonably well. So those are the key factors that have made us optimistic about equity markets. But moving on to the next slide, I've put down why we think we should stick with equities despite the rally that we've seen. There are a number of factors that have been going in a positive direction recently. First, economic news has been fairly encouraging. And that top left chart shows the all-important US ISM survey, which is a survey of both manufacturing and services. It's one of the most watched indicators by economists, and you can see that's bounced back very nicely. But if you look at unemployment, retail sales in the US or Europe, new home sales, or Chinese data, they've all bounced back pretty healthily. So economic news has been better than feared. Secondly, corporate news has been much better than expected. And that bar chart, bottom left, shows the percentage of companies in the US and in Europe in the recent reporting season, which is Q2 earnings, which we're mostly through now, shows the percentage of companies that are coming in ahead of market expectations. And you can see it is a fairly high percentage. So companies are reporting better news again than had been feared. And that's the all-important thing for investors. You're buying companies, not economies, not politics. You're buying company earnings. And as it shows, they're a bit better than expected. Top right, economies have opened up probably a bit faster than we expected, a bit faster than we'd feared. And it's really happening quite quickly now. This chart shows a measure of transport activity, all forms of transport in a number of regions. And you can see they've bounced back pretty well. And obviously we've had restaurants opening up, shops opening up, factories back working again, schools reopening, and people at last starting to go on holiday again. So reopening is happening, and that's crucial for getting economies going and getting corporate earnings going. Progress on vaccines, I mean, this is the real panacea. When we get a vaccine, then economies can really get back to normality. And there is reasonable progress on that front. There's 6 drugs in phase 3 trials. That's the final stage of trials before drugs get approved. I put there Oxford University, that the Pfizer, BioNTech and the Moderna ones are probably in the lead. Although Russia did announce in the last 48 hours that they have got a drug that has been approved already. Hopefully that's right, but the WHO hasn't been monitoring that one. But anyway, there is good progress on vaccines. And finally, but very importantly, bottom right, there are companies that are really benefiting from what's going on at the moment. Companies that are thriving in the new post-COVID environment. People like Amazon with online sales, with cloud computing. People like Microsoft, again, a major player in the cloud. The Teams networking and conference calls system. They've got live gaming. Netflix has seen a huge increase in subscriber levels. I mean, in fact, Apple, Amazon, Facebook, and Alphabet, that's the parent of Google, their second quarter earnings combined were up 18%. So if you pick the right companies that are benefiting from what's going on and have got the right business models, there's real scope for earnings growth and a healthy outlook. Having said all that, and there's no doubt that equities are our favorite asset class for the medium term, and we can see reasonable upside, just short term, markets have had a very good run, there's no doubt about it. And so we have been a little more cautious, and there are some outstanding issues that we are concerned about to some extent. The US presidential election in November, US-China trade tensions are pretty bad. And there are risks of a spike in the COVID virus in economies. So given the run we've had, given there are concerns around, we have tactically taken some profits in equities recently. And if we look on the right-hand side, you can see from that graph, the top line is equities, and that's what we've been doing this year in equities. You can see that in the worst of the bear market, we topped up holdings when we saw good value, but as markets have recovered, we've taken a bit of profit. And perhaps the other line to show is that the light blue line at the bottom, which is our bond position, and there bonds obviously rallied hard in the crisis, and we took the opportunity to reduce exposure at those good prices. So that's our view of the asset class on equities. Just very quickly to mention the sorts of things the sorts of stocks we've been holding in equities, and Felicity alluded to that, and William will go into much greater detail on it. But just to say, you know, we feel you need to have good, strong companies with today and tomorrow's business model, not yesterday's. One thing COVID has done is accelerate the trends that were taking place before, and so things like cashless payments, buying everything online, streaming, it's all happening faster. So we like to back those companies. And as I said, you want strong quality companies. It is a tough environment out there, and you need companies with good, sound balance sheets, cash flow, and experienced management. And I hope looking at those companies, you can see some real global players, leaders in some of those areas. And as a result, if you look on the left-hand side, our regional exposure relative to benchmark, the US comes up with a very large exposure. And that's because the US is home to a lot of those global dominant companies. That is a quick run through in equities. And as I said, William will talk about that in much more detail. Just to look at the other asset classes, bonds, we can see a reasonable background for bonds. And if we look at the bottom right-hand side there, you can see we expect inflation to remain very low. We think official interest rates set by central banks will remain very low for a long time. QE continues, which keeps bond yields down. There are concerns about growth, so people quite like bonds. But looking at those yields on the left-hand side for government bonds, they are very, very low. So it's a reasonable environment for bonds, but we struggle to find value, and hence we are below benchmark in bonds. Much prefer the outlook for equities. Just very briefly on the next slide to mention what we've been doing within our bond portfolio. As far as corporate bonds are concerned, as opposed to governments, we're neutral on those. That there's definitely that incremental yield you get for the extra risk is much higher than it was, but it has rallied a long way quite recently. So we take a neutral view on that. Perhaps just to mention currencies down there, the ones we're more cautious on are the dollar and our own sterling here. The dollar, it's been strong and it's benefited from having a premium growth rate compared to many other places in the world. It's been a safe haven in difficult times. And those sorts of benefits are now deteriorating, and it hasn't played its hand well in COVID. Similarly, in the UK, we haven't done very well on COVID, and we've obviously got the Brexit issue coming up. So cautious on those, preferring the yen and the euro. I'll move on from there to the final asset class we'll look at, which is property. And there we take a neutral view. There's forces working in both directions. Monetary policy, i.e. interest rates are very cheap, which is very helpful for property. We can see some areas with interesting structural growth potential, which makes us interested in those sorts of areas. And in this cycle, supply has been very limited. And that's usually what hits property values when there's been too much construction going on, too much supply to satisfy demand. At this time, banks have lent very little to property, so that's quite limited. But there are areas within property with question marks over them. And obviously, high street retail, even out of town retail is a big question mark with the shift to the internet and so on. And offices are a bit more questionable now. Post-COVID, will people spend more time working from home, etc. So just moving on to the next slide, I mentioned that there are some interesting niches which make us more encouraged about property. And this slide mentions a few of those. Industrial at the top there, that doesn't mean old manufacturing type industrial. Industrial is sheds and warehouses, logistics, distribution, designed to distribute all that kit we've been buying over the internet. And companies like Prologis in the US is the world's #1 in that respect. Areas of residential, we can see good growth. I mean, on the right-hand side there, Vonovia is a German property company in the residential area, and Germany has seen huge immigration. Equity Lifestyle on the left-hand side there, that is a company that manufactures small units benefiting from demographics, the aging population in the US. Self-storage, public storage. There's a shift in the US away from suburban living back towards city centers as people want to be nearer shops, nearer restaurants, nearer work, and therefore they're moving from larger premises to smaller ones and putting their furniture in storage. And a few other ones I've mentioned at the bottom. American Tower builds Wi-Fi towers, mobile masts, lot of use of those. Digital Realty mentioned there. Again, that is a data center for cloud storage companies, a big growth area. So interesting niches in property that the team down in Johannesburg are picking out, Keelan and Nicholas, but overall we take a neutral stance on the area. So just to finish up with where we are relative to the benchmarks for these two balanced funds, you can see that in equities there, we are a bit above benchmark. So I said we were optimistic, but there were some of those cautions and we have tactically reduced the extent of that overweight recently. Fixed income, as I said, good background, but hard to see values, so below benchmark there. Property, pretty close to neutral, and cash is the residual there. And a final slide, and an all-important slide, just to mention performance for the funds. Q2, if we look for the Global Balanced Fund on the left-hand side there, Q2 has seen a very strong bounce back, which I'm sure you will all have been delighted to see from markets. And if we look over the longer term, the 3 to 5 year bars, you can see there that the return for the portfolios has been sort of high single digit stuff, which is pretty healthy returns for a balanced portfolio over the long term. These are annualized returns, and I'm glad to say nicely above the benchmark. So between sort of 2 and 3% ahead. So we're adding useful value as well. I will leave it there, and very happy to answer any questions you have before William comes in and talks more specifically about our equity exposure.
Thank you, Alex. Felicity, we'll whistle stop through your funds, but definitely huge value to hear your thinking. And again, congratulations on navigating these markets. Certainly not easy at all.
Thanks.
Then we have some great questions. I hope we can get through them all. Very good question from Bruno on QE and just sort of around the sustainability of it. Can financial markets ever operate now without this perpetual stimulus? And importantly, I guess, what the long-term distortions this could create, risks, opportunities, and sort of how are you thinking around the subject?
Yes, I mean, certainly we have relied on QE in this difficult patch, and in the global financial crisis, we relied on it for a good period of time. And that was really the first time it had been used on a large scale. So can we get on without it? I think we definitely can. I mean, it is designed to get us through a difficult patch. And at the end of the global financial crisis, central banks did, I mean, some stopped completely, others cut back dramatically. And as economies do recover, and we do believe they will recover, life will go back to normal again, then they should be able to function without interest rates having to be kept down at phenomenally low levels, which is what QE does. And they should be able to respond to a more normal level of interest rates. They have done before, and we think they will again. So I think it is a temporary measure. And as I said, economies are bouncing back better than we had feared. And it is essential with QE that the central banks do stop doing it when economies recover. If you keep on keeping interest rates excessively low, then you fuel a boom, an inflationary boom. And that's when the monetarists will tell you you're getting into dangerous territory. So it is crucial, and we want to see economies bouncing back and central banks stopping their QE.
Thanks, Alex. Then another good question from Percy. How badly will the effect of loss of jobs and earnings have on earnings? We haven't really started to see this play through, but obviously something that is in the system and has to come out at some stage.
Yeah, I mean, there will definitely be a big hit to earnings for most economies. But there are areas, as I mentioned, who are coming through this in good shape. And I mean, NASDAQ earnings are sort of roughly flat this year, expected to be, which is a fantastic achievement in the environment. Yesterday, we did a deep dive looking at Asian equities. And again, in Asia overall, there's an expectation that earnings this year will be roughly flat. So it's not everything that's being hit, but there are a lot of companies that are clearly. We think we will see a pretty big hit for a lot of companies this year, but a good bounce back next year, which won't take us back quite to where we were before the crisis, but it'll get us quite a long way back. And the year after, we should be able to get back to those levels. And equity markets are supposed to look forward. They shouldn't be backward looking. And there's no real reason why the damage done should be a long-term structural issue. So as long as investors can see, you know, a couple of years out, getting back to earnings, getting back to decent dividends, and steady growth from there. I mean, we are back at the start of another economic cycle. And economic cycles are quite long periods. So we should have a good patch to look forward to. There's no doubt, I mean, you mentioned unemployment there. There will be a need for a lot of redeployment of people. There's a lot of companies that won't go back to the state they were in. There's a lot of industries that won't go back to the healthy state they were in. People need to be redeployed in new industries and so on. But and that process takes time, but it should happen.
Thanks, Alex. Interesting that you mentioned the Asian deep dive, because I actually thought another interesting question, is China not potentially underrepresented in the equity portion of your funds? Some great companies with tomorrow's business models and perhaps better price than the same in the US. So it is obviously something you're considering.
Yeah, I mean, that we certainly do have a number of major companies in China and in Asia. On that list of big holdings, you'll have seen Samsung up there, a major player in the IT world. Things like Alibaba, which is the big online software company serving China primarily. There's a lot of good quality growth companies that we do hold over there. But what we don't hold so much of is the old state enterprises that are quoted in China, which are the old traditional industries. But certainly, you know, we see some very good growth IT companies in China, and some companies benefiting from what is going on in terms of consumer wealth growing. And there's a huge number of consumers out there with increased wealth that are looking for services, whether that's travel services, whether it's insurance services, whether it's wealth management services. And again, we have investments tapping into that. So I think it's a great area, and we do have some good exposure there.
Maybe just to end off, Jay, my apologies if I wasn't able to get to your questions today, but please, we will do our best to get back to you afterwards, or your BDM or CFM will certainly try and follow up with Alex or Felicity. But maybe just to end off, Alex, Felicity, your view on the dollar and the strength around that, where do you think that lands up?
We're a bit cautious on the dollar from here. As I mentioned, going through, it has been a strong currency, and it has benefited from, it always has a safe haven status, and in difficult times, people love owning dollars. And now we do feel that, I mean, it's still a very difficult environment, but we do feel we're starting to emerge from it. And therefore that safe haven status is coming down to some extent. And the US economy has been a very strong, robust economy the last few years, better than most other economies. And therefore people have been attracted to invest there. Now that rate of excess growth is coming down relative to other places which are picking up and doing better. So all in all, we think that the dollar is likely to be one of the weaker of the major currencies.
Great. Felicity, Alex, thank you so much. I thoroughly enjoyed that, and I'm sure our clients did too. Much appreciated.
Not at all, delighted,
much.
and thank you very much for listening.
Super.
Bye.
Great. So thank you. Moving on to the second part of today's webinar, I'd like to welcome William Davies. It might seem strange to have included style rotation and a more equity flavor to the second part of the webinar after doing balanced funds, but we just feel that's so topical what William has recently written on, and we've been getting a lot of questions and interest from clients on the question around value and potential style rotation into value. So we sort of moved that a bit forward, and we thought that you would enjoy potentially listening to that today. So over to you, William. Thank you.
Tracy, thank you very much indeed, and of course to Felicity and Alex for the run through that we've just had. But most of all, thank you to you all for dialing in today and giving us your time this afternoon, and of course over the longer term for all your support to us and to Stanley. We really very much appreciate that support. As Tracy rightly outlined, maybe it is a little bit strange to be looking at style rotations right now, given the extreme amount of volatility that we've seen within markets. But one of the questions we are asked all the time is, if we look back over the last, say, 10 years or so, we've had an unprecedented rally in growth, or maybe quality we would add to that, at the expense of those companies which would typically be perceived as value companies, or that value style. And so the question we get asked is this all over? Going into this environment that we're in right now, where we see a lot of change, and potentially we will see recovery in economies, as Alex has rightly outlined, along with Felicity there, is now the time to be switching more to a value-oriented portfolio rather than a growth-oriented portfolio. So we'll go through some of the arguments for the pros and cons with regards to this, and like Felicity and Alex, invite questions at the end. So if we move down to the update and the outlook right now, I mean, in a way, we've heard a lot about this from Felicity and Alex. Monetary policy continues to be accommodative as we go through this quarter, and indeed we expect that to be the case as we go over coming years as we move forward. Global growth indicators show a slowdown. Well, in fact, we've seen that slowdown already as we go through the third quarter. We see the beginning of that recovery. And typically, if you're looking at value companies, or when to invest in value companies, surely it's during a recovery or an acceleration in growth, and nominal growth in particular. So maybe that would argue for a greater exposure to value as we move forward. As we go forward, though, what we try and do is not just look at the next 3 months, the next 6 months. As Alex outlined, equity markets are a predictor of what is occurring, of what is due to occur or expected to occur. We think it is very important not just to look at the next 3 months, 6 months, but to look at what we can expect over the next 2 years. And actually even more than that, and we think this is very important for this argument, to look at what may occur over the next 5 years, maybe even longer than that, in terms of the shape of the economy, the shape of what we expect in terms of growth as we move forward. And so we talk about the secular growth trends, which create potentially those long-term opportunities as we invest in markets around the world. So on the right-hand side, we look at the asset market expectations, with equity markets recovering from the March lows. Well, that's already happened, hasn't it? With the US market up year to date, S&P, NASDAQ, as Alex rightly mentioned, up over 20% year to date. Chinese market up year to date. I'm speaking from London. And certainly the UK markets are not up year to date, but maybe we have our own problems in the UK, which are not necessarily of a global making. Government bond yields as we move forward have fallen markedly, but what do we see in terms of the prospect for those yields as we move forward? Extremely important when we're looking at what type of company, what type of assets we should be investing in as we move forward. So moving on, what do we think about growth? What do we think about inflation? What do we think about interest rates? Because if we think about investing in growth companies, think about the 2010s and what we saw in the 2010s. Why did growth outperform during that period of time? Why were growth companies the better performing area? Well, it's because interest rates came down. Longer duration assets outperformed those shorter duration assets. Inflation remained low throughout that period of time. Should that occur? Should that remain as we move forward, given the amount of stimulus that is taking place? Alex talked about those $6 trillion worth of stimulus, unprecedented amounts. Does that mean that inflation should rise as we move forward? And will that have implications for that growth stroke value balance as we move forward? So that low growth, let's take a look at that right now, and look at growth as we go through 2020 and the forecast growth this year. Well, in a way, yeah, let's look at that top left-hand graph there, where it shows expected US growth around about minus 6% or so. Our forecast will be a bit lower than that, a bit worse than the minus 6%. We look at Japan, which would be lower growth than that. And consequently, you would look at the environment, and obviously it's a very poor environment with regard to growth this year. But if we're looking at the potential investing in accelerating growth, or investing in value companies, which would be higher nominal growth as we move forward, obviously we have the recovery from that as we move forward. Alex mentioned or referenced those PMIs, the purchasing managers indices, which are an indicator of potential recovery. In a way, we would be very, very surprised if we didn't see positive purchasing manager indices right now. They look at expectations of these purchasing managers who are buying for their company, look at their expectations over the coming 3 months relative to the last 3 months. So if they weren't expecting a better environment over the next 3 months than the past 3 months, which has been the worst 3 months in terms of economic contraction, certainly in my working time, then we would be surprised. So that is a necessary in order for us to see recovery, but is not sufficient in order for us to be, in order for growth to beat expectations. There's one other thing about this particular contraction, which has been very different to other recessions. And if we look at the top right-hand side there, what normally happens in a recession is that we see it is led by the industrial sector. And the consumption sector remains pretty stable. Ultimately, consumption gets hit when unemployment starts to rise, and then economic activity comes down as a result of consumption and the hit to industrial spending. This time it's different. And the reason it's different is because of the lockdown, the hit on consumption has been like no other recession before, so much bigger than we have seen before. However, we would reference, as Alex and Felicity were earlier, that this is a contraction which is brought about by the healthcare concerns, by COVID-19. It is not something which is endemic, maybe the wrong word, I apologize, but it's not something which is endemic within economies, which is driving down industrial spending or consumption. It is something which ought to repair, or at least start to repair, once we see greater confidence in movement, in activity. And Alex was showing some of those mobility indices produced by Apple, which are important in terms of predicting that recovery as we move forward. So that will kind of be a bit open-ended in terms of, would we expect to see value outperform growth? Because we would expect to see that increase in growth as we go through the next year or two. However, we have some slides. We have on the next slide some indicators about economic growth, and I come from the UK, called here the sick person of Europe, something I'm not especially proud of, but I think something which is important about this is not necessarily the left-hand side where we see economic growth, and we had the announcement in the UK this morning that economic growth in the second quarter fell by just over 20%. Quarter on quarter, and just over 21% year on year. I don't know why we call it economic growth fell by that, but the economic activity fell by that amount. And if we look on the right-hand side, I think it's quite interesting, particularly the bottom right. And this is not necessarily what we should take for all economies around the world, but it is an interesting reaction to where we are. So we look at the title there, which says, when lockdown measures are eased, how do you intend to spend? So the vast majority would say, buy the same. A small minority on the left-hand side would say, catch up. In other words, we will increase our spending once we get lockdown easing. And in fact, on the right-hand side, that 30% or so is suggesting that they will spend less. Now, why would they spend less once lockdown is eased? Well, I guess it's because of a lack of confidence in the strength of the recovery. And so if we look at the recovery and we look at the likely trajectory of the recovery, we believe it will happen, but we don't believe it is going to be surprisingly strong as we go through the next couple of years. Top right, we show that balance sheets are healthy, and the savings rate, which is shown here, has bounced. But we're expecting a bit of conservatism as we go through that recovery, and that economic activity, whilst growing, is not going to accelerate at rates which are necessarily going to surprise to the upside. So page 6 looks a bit of a confusing slide, so let me explain it really. This is something which we produced very early in the COVID-19 pandemic, back in March and April. And basically, it shows the suggested trajectory of COVID-19 infections or cases, which is in the light blue line and starts on the bottom left. It rises up to that peak of infection, and then declines as we see lockdown, hopefully reducing the number of infections. We then look at a potential second wave as that light blue line starts to rise again, where it talks about vaccine being available for healthcare workers, and it cites autumn of this year, but we don't know about that yet. But note, the peak of the second wave is meaningfully below the peak of the first wave. And then we go into a third wave, which we're not really that confident about, but we think it's quite possible. And that is around about the time that we get maybe the vaccine approved. And so consequently, a fall from there ought to be a sustainable fall in the number of infections. Now we map that light blue line against the black line, which is not economic growth in the US, the value of US gross domestic product. So the value of the economy. And what this shows is the degree of contraction that we see, which we're going through at the moment. We've gone through in this second quarter of 2020. We then start to see a recovery as lockdown is released in certain areas, and a recovery in the economy. We see the economy stutter as we see that second wave, and then we see the economy start to recover again as we see the prospects of the vaccine and then the approval of the vaccine, which we're predicting for the second half of next year. However, the value of economic activity in the US in real terms, we believe is going to reach the pre-19 levels at the end of 2022. So that effectively is a lost 3 years of growth within the US, in comparison to where we would have been without COVID-19. That is a meaningful loss of potential growth. And you could argue thereafter, would we expect growth to accelerate in order to make up for the lost growth between 2019 and 22? The concern we have around that longer-term growth is that once we get to that point in 2022, if you look at the stimulus, if you look at the borrowing, if you look at the taxes which are required in order to bring down that stimulus and maybe to repay some of the borrowings that have taken place, that means the 2020s is more likely to be a decade similar to the 2010s, with lowish growth, lowish inflation, lowish interest rates, which in our view is a better environment for the growth-oriented stocks, those quality-oriented stocks, which Alex was talking about, rather than the value-skewed stocks, which benefit from an acceleration in nominal economic activity. Between now and 2022, don't get me wrong, there will be rallies in value stocks. But if we look over the long term, we do not believe that sustainably is likely to be the case if we look out over the next 5 years or even beyond that. I'll move on from here and quickly reference inflation. What has brought about low inflation over the past 20 years? I was brought up to believe that if we had low unemployment, budget deficits, strong stimulus, we'd see inflation. We haven't seen that over recent years. Why is that? Globalization has been extremely important. Finding low-cost areas in order to manufacture. That may reverse a bit over coming years, not only because of the trade tensions we see around the world, but also with COVID-19, we think that supply chains, companies will look to diversify those supply chains. So maybe globalization is not going to be as strong an impact or have as strong an impact as it had over recent years. Technology has improved levels of productivity. It has improved or has brought down inflation as a result, and has impacted as a labour substitution. We believe that will continue as we move forward. Demographics and the increased size of the older population, again, is going to continue as we move forward. So if we look at this and we look at inflation, which has come down, we believe that over coming years, especially with the spare capacity in economies at the moment, with unemployment high, that inflation is likely to remain low as we move forward. And hence, if we look at the Fed funds rate on the right-hand side of this slide, where expectations were for 1.5% plus as we move forward, these show expectations going back a year for 2020, 21, 22, and further out. We now look at effectively zero interest rates for the forthcoming future, which is, I mean, some people would say maybe that is inflationary. I would say it's indicative of the fact that we're not expecting an acceleration in nominal growth, and we're not expecting an increase within inflation. So how to invest against this backdrop, where yes, we see recovery, but then we see lowish levels of nominal growth through real growth being relatively muted, and also inflation lowish and interest rates low. Well, you can look at the next slide, and we can see how growth has underperformed. This shows the MSCI World Value versus growth. So it shows how value has underperformed since 2007. We would say the economic conditions in the 20s are going to be similar. They won't be exactly the same, but they'll be similar to those in the 2010s. So beware of looking at this graph and suggesting we will immediately get a retracement and we'll start to see value outperforming. On the bottom left here, we see modest GDP growth. We see lower cost of capital boosting long duration assets, shift in the value chains. Incumbent business models becoming ex-growth, well, maybe, and Alex talked about COVID-19 accelerating some of the trends. There may be the digitalization that we've seen over recent years, and that bottom point, technology coming of age, cloud computing, well, that's already happened, but it's an acceleration of that trend, and we believe those winners will continue to win. And we cite some of the examples of this on the next slide. On the left-hand side, showing estimated sales from cloud services from 2018 to 19 out to 22, and the growth that we see there. And we've seen that from companies like the Amazon Web Services, Azure, over recent quarter, in spite of COVID-19, really strong growth there. Growth of capital-light, knowledge-driven businesses. Some of this we have to be a little bit careful of, because this chart, which shows the return on equity of companies in the 1970s, which is meaningfully below those in recent years, some of this is driven by retirement of equity, by buying back shares. So I have to be a little bit careful of this, but we believe in this trend as we move forward, and we look at companies like Reed Elsevier, Aon, or IHS Market as being winners here. And on the right-hand side, the share of global middle-class consumption, and we show the growth here. This chart goes from 2000 to 2050, so we can't speak with confidence about 2050. But what we would suggest is the share of middle-class consumption is going to grow in the likes of India, in the likes of Southeast Asia, in China, as a proportion of growth around the world. Again, it is an area of sustainable growth, which we believe is going to continue to be an area to profit from when investing in global markets. And so to conclude, the global economy slows. Well, we've already seen that. But as we recover from that COVID-19 induced lockdown, we do not see a sustained acceleration in growth, which goes beyond that time when we get to a level of economic activity which was similar to that at the end of last year. So that environment is one of low inflation, low growth, low interest rates, similar to what we saw in the 2010s. That doesn't mean there are not opportunities for investments. Absolutely not. However, we believe that those opportunities will remain greatest in those companies that are quality growth oriented, where companies dictate their own future or have control over their own future and continue to grow as we go through some of the challenges which will emanate as we emerge from COVID-19. I will leave it there, Tracy, and pass back to you for questions. Thank you very much.
Super, William. Thank you. Absolutely fascinating. And actually, William's full piece on the subject is on our website if you'd like to read it, as well as some other super pieces by Columbia Threadneedle in the thought leadership space. So that's there for you if you'd like some additional reading. William, maybe, I guess a really good question from Bruno, if you've got some time, is, do the traditional metrics of valuation still provide insights in a changing world where the nature of capital assets are increasingly intangible, digital, and intellectual in nature? I thought that was an interesting one to pose to you.
Bruno, that's a horrible question, because it's so good. Thank you very much indeed. So what I would suggest is that what we do is we're looking at investing within Columbia Threadneedle. We do not rely on one valuation metric be that discounted cash flow, be that PE, be that EV/EBITDA, be that return on equity, and say that is the only metric which will drive valuation. I think it is important to look at a group of metrics, valuation metrics, when looking at a particular company and evaluating whether it is right to invest in that particular company. I brought up the chart before, which showed the return on equity as we go across a number of years. Now, return on equity, to have a high return on equity is generally considered to be a good thing. However, if you have a high return on equity because you bought back meaningful numbers of shares and your leverage goes up, the riskiness of your particular company also goes up. So I don't believe it is wrong to look at the metrics which we have looked at in the past, but what I would say is do not look at them in isolation, because you're absolutely right. The level of those intangible assets will mean that the level of equity within a company is likely to be that much lower. And so look at a company for what it is, rather than just those metrics. In a way, it's looking behind the balance sheet, looking behind the P&L to see what is driving that. But excellent question, because you're right, world is changing in that respect.
Actually, Bruno asks another question. How is it possible for value as an investment factor to ever compete against such determination by central banks to undermine true price discovery? So we're not getting a case where inefficiencies and distortions in markets are really, I guess, just not being discovered or not as obvious as they would have been.
Yeah, I mean, that's quite an interesting one, I would suggest, because if when I was talking, going through the presentation, one of the things I said was, you know, when I was taught about economics, I was taught, you know, if you have economic stimulus, if you have low unemployment, that would likely lead to inflation coming through, interest rates going up. And so consequently, you would then get that price transmission coming into those companies, or ability for those companies to raise prices where they don't necessarily have such control over the prices because of the economic environment. But to my mind, I think that slide which showed technology, demographics, and of course, what was the other one? In terms of globalization, how can I forget about globalization? If we look at those three drivers, they have helped drive inflation down and make it more difficult for those companies which are reliant upon the economic cycle to drive prices rather than being, you know, having control over prices themselves. That is the thing which I think makes it more difficult for those value companies as we move forward. If we move out of that and we can have, for instance, through low interest rates and stimulus, we can have rising inflation, but it's difficult with those other three things which are impacting prices. So I think that is the key determinant of why it's really quite tricky for value to be as dominant as it may have been in certain other cycles.
Thanks, William. Well, we also look forward in 2 weeks' time to listening to Neil Robson and his views on the Stanlow Global Equity portfolio, which he manages, which I'm sure a lot of the same thinking will come through there. So that's something to look forward to. Thanks, William. I think for once I might actually wrap up on time. It's not something I'm known for because I tend to talk and talk, but we're about to hit that 3 p.m. mark, and I think I've covered most of the questions. So we'll probably wrap up.
Thank you very much indeed.
Super, William, and thank you to everyone for joining us. Really great to have you with us this afternoon. Take care and stay safe. Thank you.